Welcome, everybody. This is the Origin QOZ Fund webinar update. I'm Michael Episcope, co-CEO of Origin Investments. And you may notice I'm wearing a pullover here in the middle of summer, and I'm doing this because my 18-year-old is on this sleeping kick where he likes to sleep in 65-degree weather, and I happen to be on the same floor as him, so I'm sitting here in an ice box right now. But it's not this cold in Chicago as I look out the window today, but that's why I'm wearing a pullover, and just because I like Origin swag. It feels good. Buy quality stuff here. David Welk is joining me today from our Charlotte office. David is, he's been on this before on other webinars as well. He's our Managing Director of Acquisitions. Welcome, Dave.
Thank you, Michael.
Dave is responsible for sourcing many of the deals in this fund. He has a hand in every facet of our investment management strategy, and he's been integral in making Origin a top manager. He's been with us for more than 10 years. And Dave, he has got some gray hair, but I will tell you personally, he can keep up with the young folks on the team, and you might see him dancing until 3 a.m. After one of many Origin's outings. Always a pleasure to have you on, Dave. I'm going to cover the state of the market today and fund overview, and then Dave is going to dive into a couple of the fund deals and really go into sort of the details, update you on really the fund's progress, the portfolio construction, the pipeline as well. We are going to try to keep our portion of the presentation to about 35 minutes and then open it up for Q&A. So please submit your questions in the Q&A box and not the chat box. Q&A box only. We will be addressing those. And certainly to those of you who have emailed questions in advance, thank you for those. We try to weave those into the presentation. We may not address those, right at the end, but I think you will hear the answer to many of those throughout this presentation. So I'm going to jump in to state of the market right now. Slideshow is beginning. And we've been talking about the state of the market up front in all of our webinars because we know this is what is on everybody's mind today. And I'm going to specifically start with interest rates. Producer price index came out. These are wholesale inflation numbers, and the numbers were awful. These are inflation numbers, and it came out at 11.3% higher on a year-over-year basis. So the stock market is sliding again today. And, to me, to say the Fed fell asleep at the wheel last year is an understatement at this point. And I think most would agree, right? They were being cheerleaders at the time when they should have been really reacting, talking about transitory inflation. And, now it's likely that they're going to have to overcorrect going the other way. In the last month, I've actually gotten 2 questions from investors about what happens if interest rates go to 9%. They actually asked the exact same 9%. I don't know where that number came from, if it was a coincidence, but they both used that number. And my answer in both cases goes something like this, right? At some point of stress, as this is what you're asking, we're going to lose money. We're taking calculated risk, and it's based on a world of normalcy. Now, I will tell you that every business plan should be able to withstand 1 to 3 standard deviations. And you can make the argument that the move in interest rates today has been so volatile and so fast that this is probably close to a 2 standard deviation. But at 3.5% in the 10-year, we are fine. But if you believe that rates are going to 9%, I hope you have gold in your portfolio, because that's one of the only things that is going to work in an environment where, short-term or long-term rates is at 9%. And this country can't afford rates at even 5% today with the amount of debt we are carrying right now. So it's, we're managing the properties, we're building to higher cap rates, we're doing what we can to hedge our interest rates, but keep in mind that we have a lot of projects that are under development. We can't fix rates. We can't do that right now. And the other thing about interest rates that you have to keep in mind, and I've said this on previous webinars, is that it really is a double-edged sword. We can quantify the increase in cost to debt and infer where cap rates might be, and both those are negative to our business plan. Higher debt costs, higher cap rates are going to hurt value and hurt operational cash flow, and cash flow that comes back to investors. Demand, though, is always harder to quantify because it tends to be amorphous in nature. And what's happening today with this rise in interest rate is it's actually net beneficial to us. And that might sound counterintuitive that, this move in rising interest rates. And we were really, really concerned, and we still are today. We don't want higher rates. But what has happened is that 20 million people today in this country no longer qualify for a $400,000 mortgage because of the rise in mortgage rates. Mortgage rates 6 months ago were 3%. Mortgage rates today are north of 6%. And people are just, they're priced out of the market. And what that leads to is trapped renters, people who want to buy, but they can't. And as a result, what we're seeing in the market today, the rental increases at our properties are equivalent to last year. They are in low double digits, 1% a month, even more than that right now, because you not only have existing renters who maybe want to leave, but they can't, but you have more and more coming behind them. From a capital markets perspective, what we're seeing in the market is that capital is pulling back. We've sold a lot of our deals in Fund II and Fund III in the last year. I would say 8 or 9 months ago, you had 20 people who were showing up at the property. You were getting 8 bids in the last, and everything, by the way, was going above the broker opinion of value, which you always get when you're going out to market. And it was trading at 10, 12, 15% above that value. And recently, we just sold a deal last week that actually came in 5% below a broker opinion of value. We transacted. We still think it's a great price to be exiting in the market, given all the uncertainty and where prices have gone in that fund. But our best estimate today is that prices are probably down 5% to 10% from the high right now. And it's reasonable. It's healthy. I don't, people should understand this is not 2008 all over again. This isn't a cliff. Things are not falling off. The underlying fundamentals are still really, really strong in real estate, as in residential real estate. There's still an undersupply in most of our markets because of these demand shifts that have happened so quickly. It takes years for that supply to catch up to things like this. A lot of the volatility and decline in prices, though, has to do with the fact that there's negative carry. Properties in the last 6 months, they've been trading at 3.5% cap rates. You've actually seen properties even closing in the last kind of 2 to 3 months at 3.5 caps, even though borrowing costs are 4.5%. A lot of that just has to do with inertia. Funds that have things tied up, they want to close the deal. They justify it somehow. They're borrowing at 4.5%, maybe with the hope that rates go down, but the math really doesn't work there. So we do believe that you're going to, see this kind of 5 to 10% healthy correction, and that deals that were closed in the last 6 months probably had 10% too much froth in them, and those are going to come back down to realistic levels. We are starting to see cap rates trend towards 4% again, and they may even move higher. They're not quite there yet. They're still, the transactions that we're looking at in the market, backwards looking, are 3.6, 3.7, 3.8, but creeping up. And certainly in our models, we've never used spot cap rates or today's cap rates. We've always had an adjustment. And even today, we're trying to infer where cap rates are and using a buffer of 25 to 50 basis points to where current cap rates are. Because one thing you have to understand is that cap rates are backwards looking. And again, the inertia, a lot of these deals closing at 3.5 caps, to us, that's just noise. And our job is to really look at the horizon and out into the future and say, where are they going, or where could they be going, so we can manage risk properly. The irony is that, with the 10-year, it continues to move, higher right now on a day like today. But if it moves lower, that is where you actually might see rent growth decline because of these trapped renters moving out of multifamily. Many of them are chomping at the bit to own. And when we think about higher rates actually being healthier, that's counterintuitive, and lower rates maybe actually leading to lower demand. This is something that could play out in the future. It's a wait and see. I don't have a crystal ball, but these are scenarios that we're thinking about. A lot of questions came in about recessions. My own perspective, and many people at Origin share this, is that we are in a recession right now. That I don't think I'm stepping out on a limb here, making that call with what's happened in the stock market and a lot of the news. Our predictive models, Origin Multilytics, they're showing it's showing rent growth cooling in the next 12 to 24 months. Some submarkets going negative, but over 5 years in all the markets beyond, the average 5-year rent growth is actually positive. And so this is going to be, there's going to be some volatility along the way. But the nice thing is about the QOZ investment is we're developing to higher cap rates in the future, which mitigates a lot of this risk that we're seeing today. And we are forced to be a long-term holder. The minimum hold period here is going to be 10 years to get the benefits. This will not be the last recession this fund sees. And keep in mind that institutional quality real estate, it's never lost money over any 10-year time horizon. We as a firm, I think we excel in risk management. We think about these things. This is why we're using substantial equity. We use 35%. We're using non-recourse debt. We don't cross-collateralize assets. We're in the right markets. We're adding tremendous value. And to me, that's a recipe for long-term success, and one that we've used for the last 10 years and what it's gotten to us. It's gotten us to where we are today. I talked about this a little bit. I believe the Fed will overshoot. And I also believe that the 10-year is going to come back down to 2 to 2.5%. And that's based on data and information and looking at past history. There's never been a recession where the 10-year hasn't come down by at least 150 basis points ever in the history of the United States, even in the 1970s when we had this runaway inflation. And I think overall, we all have to be prepared to be on a roller coaster ride for the rest of this decade. Shutting down the global economy, it's caused systemic issues that don't get solved in a year or 2 years. The housing shortage we're seeing today, that can be traced all the way back to the great financial recession. So we've got a long way to go before we're completely out of the woods here. The next thing I want to talk about, construction prices really quickly. The good news here is that we are starting to see them level off. We were seeing north of a 1% rise every month for a while, and in some months we're north of 3%. Annualized increases were 15, 20, even 30%, if you can believe that. And today it looks like we are sort of back to that typical 3 to 5% increase in cost per year. That's what we're modeling, what we're seeing out there. Things are certainly coming back to normal, if you will. Labor is sticky. We don't think that's coming down at all, but material costs have come down. Some of the slowdown in the for sale housing market has actually benefited the rental housing market, that demand has pulled out. We've all seen the housing starts have fallen off a cliff because of mortgage rates, and we're benefiting as a result of that. Commodities are coming down. We've seen lumber trading now between $600 and $700 per board foot. And that's down from a high of $1,600. And that can be the equivalent of millions of dollars of savings across each and every project. So when you think about, having 10, 12, 13 projects in this particular fund, if lumber sits in this kind of area versus being at $1,600, $1,700 at the highs, that could be $30, $40 million in savings in our projects alone. And we're starting to lock some of that in through our GMPs, especially in projects that are going vertical right now. Supply chain issues, they are manageable today. We are ordering things 12 months out, maybe even 18 months out, that used to have lead times of 6 weeks, but it's not as dire as one would think. It's a management issue, a construction management issue, and just making sure that you give enough lead time to have things like appliances and other items in that might have that 12 to 15 month lead time. And so there are some silver linings here, to what's happening in the market. And there's 2 more things here. I already touched on rent growth here, so I'm not going to go into that right now. I think everybody, is aware the millennials are peaking. They're about 32 years old right now, so they are chomping at the bit. And that's going to probably end up, creating maybe cooling demand in the next couple of years if we see the 10-year come back. But that's just a guess. If 10-year stays here, we're actually in pretty good shape when it comes to continued demand at multifamily properties. The best news I can share with you is really coming out of Congress today, and there's pending legislation to extend the QOZ program by another 2 years and bring back the 15% step up in basis. The deferral would go out to 2028, so taxes wouldn't be payable until 2029. So it's another 2 years of free, kind of an interest-free loan for from the government. That's going to be voted on later this year and would be a welcome change to kind of offset some of these headwinds and mitigate some of the risk through that step-up basis. We're going to keep you posted here. We're looking at it. My best guess is this is going to happen late Q3, early Q4. It's going to be wrapped up in some of these other bills, but it still has tremendous support in Congress. Let me jump into the next slide. This is really about the fund. And I assume everyone is familiar with the QOZ benefits by now, so I'm not going to cover those in detail. I know we have existing investors plus new potential investors. If you're not familiar with those, please go to our website, download the deck. You can read all about them. This webinar is really an update about the fund. The strategy of this fund, it's to build Class A properties in growth cities, Sunbelt markets, low tax, climate friendly states with the intention of holding them for the long term. This is what we call build to core. We're building a margin, protecting our equity through that growth, and then we're holding for cash flow, depreciation, and tax benefits for the long term. Cash is going to be returned to investors through both cash flow and the refinancing of properties. We haven't really changed this at all in terms of our updates. It's kind of too early in the fund. There's a lot of money that still has to put out, a lot of developments that haven't broken ground yet. And investors who are in today and who are buying it at a fixed unit price of $10. And investors are equalized through the preferred return. You start earning that on the day you invest. So you're not going to see that unit price fluctuate until after we've closed the fund, and we will then mark that to market once all investors are in and we've raised all the capital. Today, the capital commitments, they sit at around $158 million, and we're going to close it when we hit $300 million. We always get questions about when we're going to hit that cap. It's a little bit tough to guess using kind of past historical information. I will tell you that I think we'll hit it by the end of this year. Fourth quarter tends to be, oh, my camera went out for a second. Fourth quarter tends to be a big quarter for us. Last year, we raised over $200 million. And we have a date coming up in September, which is the last date by which you can still invest 2021 gains that were that came through a partnership, because it's really 6 months from, I believe there's all kinds of nuances out there, but it's 6 months from the end of the the beginning of the partnership tax year, March 15th. So you go out to September now. So if you have 21 capital gains and you think you've run out of time, you may want to look at those again, especially if they're through a partnership, because the real date it happens in September. If this legislation passes, which we think it is going to, we're going to see a massive influx of capital into the fund. And it could be that we're closing Fund II as early as September. And then we would be on to Fund III after that. The fund already has a lot of seed assets. Dave's going to discuss these, go over a couple of these as well. And we estimate that we're going to have about 10 to 12, maybe 14 assets in total in the fund. So your capital is going to be diversified across a fair number of assets and geography. Let me share this next slide with you. This there is really no update on this. We've been showing this since we launched this fund. This is our best estimate of cash flow that's going to be coming back to investors. And over, between now and 2026, our estimate is that investors will receive 20 to 25% of invested capital back. That will come in the form, most likely through refinancing of properties. So every property, once we build it at about year 3, we're leasing it, we're able to go out and refinance that property and take capital out of that. All of the money that we send back here, whether that's through refinancing proceeds or cash flow, will be tax-free during that period. The nice thing is that if they do extend this program out to 2028, that's going to be another 2 years that we have to send cash flow back to investors. And we estimate then we'll be able to increase that number from 20 to 25% to, somewhere between 30 and 40% at that time. The next slide, and I believe this is the last one I'm going to go over, is really reiterating the tax benefit analysis. And the goal of this fund over 10 years is to generate a 2.25 to 2.5x multiple over that time period. And I will just, tell you right now that if you have capital gains and want real estate exposure, there's no better investment than the QOZ program, QOZ investments. And what you see in front of you is an example of what a $1 million investment is expected to generate on an after-tax basis, utilizing all of the QOZ benefits versus just to the left of that is investing with traditional money, right? After-tax capital in a non-QOZ deal. And so what you see on the right is the QOZ investment. It's not taxed at all. So pre-tax and post-tax money is really the same. And you have the tax deferral benefit as well. You can find this in our deck, this math, if you want to go through it. The zero interest rate loan is, that and the step up in basis, which we don't have this year, but I'm hopeful that it will come back. That provides amazing after-tax benefits to every single investor. And the net of a QOZ investment is that it's going to increase your after-tax profitability by 50, 60, 70, 80%. The more you make, more we make you in this investment, the greater that spread becomes. And this, what you see in front of you is simply to illustrate the tax benefits of the fund. David and I just can't emphasize this program enough. I'm investing more money here. David is. This is, if I had more capital gains, I would put them into this fund. We're funneling as much as we can here. So I think this is a fantastic program, and it's really a gift from the government. So if you're considering investing in real estate, definitely, I don't know, I can't even recommend one of our other funds over the QOZ fund for an investment if you have capital gains. So Dave, with that, I'm going to hand this over to you for you to talk a little bit about the fund, and then we'll bring it back to Q&A when you're done. Thank you.
Thank you, Michael. And just want to let you know that I'm also sporting some high quality Origin swag today as well. And I appreciate you highlighting my late night dancing skills. These have been honed over the past 2 decades, and I'm still learning some new moves thanks to my boys into TikTok. But I'm just realizing also that I think the last time we convened was for this webinar, it was Masters Week. And I guess we're trying to time these around the majors. So happy open week for all you golf fans out there. Good morning from Charlotte. As Michael mentioned, I'll be focusing at a high level on our overall investment strategy, and I'll be using the Atlanta market as an example. And then we'll dive into some of these specific seed deals, notably our multi-phase asset located in Chosewood Park, submarket of infill Atlanta, known as Sawtell, and then 2 of our newest fund assets, which we just closed in the past 2 weeks. And these are 2 build-for-rent investments in suburban Atlanta and Nashville, known as Ava Gainesville and Ava Nashville. And to provide a little historical context for those of you who are new to Origin, and apologies to those of you who've heard this before, but we came across the OZ investment opportunity based on a pursuit of a project here in Charlotte in 2018, just as the opportunity set for OZ investing was emerging. And what we found was when we overlaid the OZ maps with our current portfolio, as well as our pipeline of opportunities, is that many of these submarkets that we had identified as target markets already resided within the OZ delineations. That's due in large part to the fact that we have a focus on high growth, gentrifying submarkets in mostly the Sun Belt and mountain regions. But these OZ maps were drawn using the 2010 census data, and much of the gentrification that's occurred in these markets over the past decade have occurred in the urban cores, as you can see on the map here shown in Atlanta. And the underlying demographic makeup of these nodes and locations has changed dramatically over that period. And one of the best examples that we can see here is in Atlanta, and specifically we'll discuss the Sawtell opportunity here for Fund II. But specific to this site, as an example, the rapidly changing demographics. The 2022 AMI for this particular project is area that's defined as area median income is about 60,000. The average household income, which we look at the spread between the median and the average to determine momentum and gentrification, is 96,000, which is double the 2010 mark that was used to qualify this particular site as an OZ designation. In most of these locations, that was about a $30,000 AMI in 2010. Which precipitated its placement into the OZ program. So as you can see on this map here, the OZ locations kind of all surround the urban core of Atlanta. But unlike Nashville, which we highlighted in the last webinar, where these tracks can be found in nearly every direction from downtown, Atlanta's submarkets are largely concentrated in the west and south submarkets from downtown. In the southern OZ location of Chosewood Park, where Sawtell is located, this location's received a significant shot in the arm through the planning and development of the Beltline Trail, which has served as one of the most catalytic public works programs in the country for creating rapid gentrification. And we'll talk a little bit more about this here in a second, but this has resulted in a huge increase in property values for properties located within the approximate to the 57-mile multimodal trail throughout Atlanta. And we've reviewed some studies that have shown that the Beltline effect is most visible in properties located within approximately half a mile of the trail, which we're excited to boast that Sawtell is located within that ring. Not only is our site located within the ring, but we're also working with city planners to obtain a spur from the Beltline through nearby, across the street, Chosewood Park, that would bring Beltline access to our front door. Outside of this, within Atlanta, our focus has been in some of these other gray shaded OZ zones, most notably in downtown Atlanta, and some of the additional micro markets that are located here on the west side. And we pursued a number of these opportunities in these locations over the past several years for Fund I and more recently for Fund II. And although we've yet to connect on anything in particular, we remain focused on our efforts to build positions in these submarkets as well. And not shown on this map, as this reflects only Atlanta proper, and actually this is a map of Fulton County. There are a handful of suburban locations that have also received OZ designations in Atlanta, most notably Ava Gainesville, which we'll talk about here in a second, not shown on the map because it's located north and east of Fulton County, is one of those suburban markets that's also experienced significant gentrification. And the AMIs and AHIs for that particular site are now reaching nearly 60,000 and 82,000 respectively. So on the next slide, we'll talk here about the seed deals within the fund. And as I mentioned, I'm excited to cover 3 of these deals in more detail, as I previously referenced, but I wanted to point out, we added a couple pieces of data to this slide from prior presentations, and to note in particular, the strong underwritten stabilized yields that we're forecasting here. And as you can see in the chart, as we go deal by deal, these range from kind of the mid to high 5% range. And for the 2 assets that have tax abatements, which are footnoted here, which is the Ava Gainesville project and the Rio project in Colorado Springs, we anticipate achieving north of a 6% stabilized yield. And how these yields are calculated, they're based on actual development costs, of which we've underwritten healthy contingencies, and we can go into more detail later on specifically what those are. But generally speaking, we're underwriting somewhere close to 0.5% a month of inflationary contingency and cost from when we close on the land to when we actually break ground and go vertical. And then we're overlaying current rents into those forecasts for yields as well. The other thing we've added to this slide here, and this is fresh data, hot off the press. We recently updated our AI forecast, and we've probably most significant revision to our forecast that we've added in is we've included a series of different recessionary overlays. And as Michael touched on previously, we're not sure what type of recession we're in store for. So many of us believe we're already in one. Our base case now we're looking at a moderate recession, but we also have overlays that show no recession, of which I'll happy to point out that our AI modeling tool suggests that we're at nearly 100% probability of some level of moderate recession in the next 12 months. But we also have a severe recessionary forecast. And we create this striated band of returns, and we stress all of our investments based upon these different scenarios. And so many folks have asked, hey, what's going on with the supply and demand fundamentals in each of your markets? What's going on with affordability? I'm happy to report out that in a number that you're seeing on the right-hand side of the screen, we take into all accounts of those variables for each, and we go down to the specific property level, the geocoordinates of that project within a given submarket to develop these forecasts. And so what we've done is we've factored in 2.3 billion pieces of data go into the soup in calculating these forecasts. And as you can see, some of these, what you don't see behind the screen, you just see the roll up over 5 years, is that some of these submarkets, as Michael mentioned, do include some negative rent growth. But what you're seeing is over a 5-year period, because we've picked high growth markets and we're playing in the segment of affordability in most of our projects, we're seeing at or above 3% inflation or market rent growth in all of our markets. And in some cases, in the cases of the Springs and Phoenix in particular, you're seeing substantially above 3% rent growth over a 5-year period. So we believe effectively rents are going to go up, they come back down, and they spike again, and you're kind of leveling out over a 3 to, in some cases, 5 to 7% rent growth over a 5-year period. On the next slide, we'll jump into and talk a little bit about the Sawtell project, which is a very compelling project for us as a firm. This is projects in partnership with Atlanta and Miami-based Kaplan Residential as our fee development partner. Together, we will be master planning a 40-acre fully entitled land parcel located in one of Atlanta's most actively developed opportunity zone district in Chosewood Park. The site itself is a former Lakewood GM assembly plant. So they manufactured cars here. Over 30 years ago, there was over 2 million square feet of production buildings located on this site. Over the years, almost all of those have been raised. There's 2 remaining 166,000 square foot industrial buildings that were former production buildings themselves, which have been repurposed and are being utilized by a number of film crews. Notably, Netflix is occupying one of the buildings for filming of the TV shows and movies. The project itself is located, as I mentioned previously, within a half mile of the significant amount of development that's occurring immediately on the Beltline Trail itself. But the submarket over the past 18 to 24 months has along the Beltline Trail has seen a number of retailers come to the market in a number of OZ and market rate development projects alike. So said differently, a lot of developers who are not necessarily taking advantage of the OZ designation still believe that this submarket can support development without the OZ tax benefits. And that's kind of in a nutshell our thesis of we look to develop projects that we would have developed had not the OZ existed as well. So due to the submarket benefits, again, as I mentioned, from the proximity to the Beltline, but in addition to that, we've got great proximity to the Atlanta Zoo and the infill neighborhoods of Grant Park, Peoplestown, and Boulevard Heights, which are all seeing significant gentrification. And a lot of that's being driven by the cost of home ownership in-town submarkets within Atlanta has grown quite a bit. And so it's pushed folks south of some of the eastern neighborhoods of infill Atlanta. And we've seen in the last 12 to 18 months that single family home values here in this immediate submarket have seen significant increases as well, upwards of 500,000 to 700,000 per unit. The project is zoned for up to 12.4 million square feet of mixed use development. That's one of the things we loved about the project, is that it didn't have to go through a rezoning process. All the entitlements were in place at closing. However, we plan to program substantially less density than that and what the site allows. Within our master plan, which you can see up in a kind of small format in the right-hand corner of the slide, we're developing a master plan that contemplates primarily a residential build out in a multi-phased community spanning nearly 2,000 units. And the ultimate construction timeline is yet to be determined. We're going through a number of local permitting processes that are required within Atlanta when you do a large scale mixed use project. But we believe that over time, the entire project, the master plan, can be delivered over roughly a 72-month timeline. And so what we're contemplating for the first phase is about 700 units to be delivered over the next 24 to 36 months. And if you build out the entire project over its entirety over 72 months, the project itself could have a total consideration of upwards of $500 million. Not sure exactly how that's all going to come together from a phasing standpoint. We know what phase one is going to look like. Phase two will be dictated a little bit on the success of phase one and market timing and other forces. But because of the size of the project, as footnoted on the seed deal slide, we'll likely be offering up a number of sidecar opportunities for the various components of the master plan. Excited to go to the next slide and announce the Ava Gainesville project. These two this along with the next slide, which we'll cover in a second, the Ava Madison project. We've closed both of these projects in the last 2 weeks. And these represent our first two build for rent projects within the fund. Both of these projects will be in partnership with Atlanta-based two capital partners. And we've had a relationship with the two principals for a number of years, and we're excited to finally connect on some investment opportunities with them, given these dynamic projects and getting these dynamic projects out of the ground. Particular to this Ava Gainesville project, this is a 231 unit community, as I mentioned, comprised of build for rent, and it's split between townhomes and single family rentals. This is located on a 25-acre tract that's about 1.5 to 2 miles from downtown Gainesville. And for those of you who aren't familiar with downtown Gainesville, this is a historic downtown suburb of Atlanta. It's about 40-ish miles northeast of downtown. But if you go to downtown Gainesville, like some of these other suburban Atlanta submarkets that have really taken off in terms of its demand and appeal as these markets continue to grow, if you go there, you'll see cobblestone streets, and there's a central park and a collection of well-established restaurants and shops, breweries and boutiques. So it's got this great downtown self-contained feel to it to augment this very in-demand type of product in the marketplace. Supporting, in addition to the downtown, supporting the drivers for this location, there's a number of healthcare and education jobs located immediately within Gainesville. And then you've got immediate or very, very close proximity to the huge job centers in Gwinnett County, Alpharetta, and Central Perimeter in Atlanta. We are excited to deliver this product to the market. This is going to comprise of 161 2, 3, and 4 bedroom townhome units and 73 and 4 units single family detached rental homes. And one of the most exciting aspects of the project, which we highlighted earlier, which is going to create outside yield for this investment over the life of the whole period, is that we are in final negotiations with the local taxing authorities to secure $10 million abatement. Roughly, the way that'll work is it'll offset 85% of our tax bill over a 15-year period, or with the exhaustion of the 10 million of proceeds, whichever comes first. But that's a huge benefit for this project. I mean, effectively creates a negative $3 million land basis in the project. So very exciting for this project to move forward. Lastly, I'll hit on Ava Madison, and then I think we'll be wrapping up here. But I won't spend a lot of time covering the fundamentals of this particular investment, but this location here in Goodlettsville is a northern suburb of Nashville. It's about 20 miles north of downtown. We'll be developing 93 attached townhome units and 106 single-family detached. So unlike the Gainesville project, where we had a few more townhome units as a percentage of the overall unit mix versus single families, here we're slightly more weighted to the single family units here. And I'll mention as to why the particular unit mix was selected here in a second. A few notes on this location: we're located within a mile of Dollar General's headquarters, which employs nearly 3,000 people. And then we've got similar to the Gainesville project, we've got a number of healthcare and advanced manufacturing jobs that are located within immediate proximity to the project, including a large facility for Tyson Foods. And adjacent to Goodlettsville is a high-end submarket of Hendersonville, located within a 10-minute drive of the project. This particular, that Hendersonville is a submarket, boasts some of the highest quality schools in all of Nashville, some great jobs up here in the suburban location. Mentioned before why we weighted the unit mix higher to the detached single family homes here is because the single family homes here are trading at a pretty large premium to our development basis, upwards of $150,000 to $200,000 per home. So there's a huge demand for, obviously, on the for sale side of it, but there's also large demand on the for rent. And as Michael alluded to earlier, the millennial demographic with rising interest rates for mortgages, although they want to live in this environment and own their own home, in some cases they're going to get priced out of that market. So this is a great substitute good for that large cohort in the market that desires single family rental. There's also significant performance in the upside of this deal that is not being incorporated into our underwriting. We really did. I mean, we looked at comps and came up with some discounted underlying starting rents, which are a few $100s a unit below what our AI tool suggests that we could underwrite the deal to. So there's some significant cushion, I think, in this underwriting and the chance for this to outperform our projections as shown here. And then with that, Michael, I think we're heading towards the end. This is our next slide, the Q&A.
Yeah, Dave. Gotta reset my camera here. This one out. So, yeah, why don't you grab the first question? I'll fix my camera.
Yeah, no problem. So thank you for all who've sent in questions to us in advance. I'll take the first one, which was, are the current projects over or under budget? And great question in this environment, especially in this inflationary cost environment. The short answer to this question is they're on budget. And the reason why is because we are just breaking ground on the Rio project in Colorado Springs, literally in the next week or two. The two AVA deals that I just completed discussing, those are breaking ground in the next 30 days. And within each one of those deals, we've underwritten very healthy contingencies. But the rest of the deals in the pipeline, for the most part, are breaking ground somewhere between third and fourth quarter of this year and first and second quarter of next year. The two larger mixed-use projects, Edge Hill in Nashville and Sawtell in Atlanta, those are still going through the design process right now. But we incorporate significant, 0.5% per month, per year, or per month inflationary hedges and costs in all of our underwriting. So we feel like that inflation is going to moderate over time, but we're not far enough along in each of these projects yet to state whether we're over or under budget. But I feel like we've taken the necessary precautions to underwrite, again, healthy contingencies in our budgets.
All right, I got my camera fixed. I'm switching to the old school computer camera here. I'll take the next question, Dave. Which state K1s will investors receive, if any? Certainly, every state that we're in you will receive a K1. We have composite elections, which makes it really simple for people. If you elect into that, you only get one K1. And also keep in mind that states that have zero taxes, you have nothing to file in those states. So even if you get a K1, you don't have to file it. So when we're talking about Tennessee and Florida and Texas and places like that, those K1s don't need to be filed.
Do you want to take the tax strategy available for investments in 2023?
Sure. Yeah. This QOZ will be around in 2023, and we're hoping that with this legislation gets pushed out to 2028, it'll be available all the way through 2028. So it's just a matter of if there's a step up in basis versus an environment like 2022 this year, the step up in basis went away, but it might be coming back. So 2022, 2023 would still would bring back that step up in basis, and then it would go away. But hopefully we'll be investing in QOZ projects through 2028.
Great. I'll take the question on concerns on overbuilding or oversupply in build for rent markets. Pretty timely, given that we just spent some time covering the two newest acquisitions or closings within the fund, the two AVA projects, which are build to rent projects. And I will say that, we've looked at we look at each project as a percentage of the overall inventory of supply that we're delivering to the rental markets. I mean, they compete with traditional multifamily to a degree. They're both rental products. Ideally, you've got a discerning renter that's looking to rent in your project, someone maybe who wants a private fenced-in yard, who wants the environment where they're not in a shared wall situation. There's a very large segment of the population that is interested or desires to live in a build for rent community. And it's not just the millennials, for what it's worth. It's also the huge growing boomer population that is looking to downsize, looking to have a professional property manager come in and take care of the maintenance of the home. So we actually have a growing segment from two of the largest demographics in the country that are in demand for this project or product. But I'll say as a percent, the soundbite here is that build for rent as a percentage of the overall inventory is minuscule. It's 2% of the overall inventory. So we don't feel that there's a concern at all for build for rent. There is substantially more capital chasing these opportunities because they're so limited in terms of the number of projects that are coming out of the ground. So we actually really don't have much concern at all of oversupply in our markets.
Dave, I'm going to take this next question. This is from Anonymous. And this is a great observation. And this person says, on the last few QOZ calls, I seem to remember the underwritten stabilized yields being more in the low fives. What have you changed in your underwriting to get up to the mid to high fives? And the answer is simple, that when you think about the return on cost formula, you have NOI divided by costs, and costs have sort of slowed down the escalation. And in fact, we've been saving in places like that. But rental rates have been still running incredibly strong, dropping more to the NOI. And keep in mind that that's an unlevered metric, that you're not factoring in higher rates, things like that. You're only looking at the net operating income of the project and taking that against the costs. And so in this environment, what I was saying earlier in the beginning is that we are still seeing operational revenue increases 1% a month, as much as we were seeing last year. And last year, in certain markets, we were up 15 to 25%. So that equation has only gotten better because our costs are fixed and the revenues continue to run. And that's why you're seeing actually a higher return on cost in what Dave was presenting than the same ones. But great observation, and thank you for bringing that up.
All right, let's see. I can take this next one, Michael, which was written in, which is, and we've somewhat addressed this, more recently in my answer on how we're underwriting escalations in each one of our projects. But the question is, in light of rising construction and borrowing costs, what revisions are you making on projected rents and net returns? And Michael just alluded to some of this, is that on the unlevered yield basis, we are taking our AI market rent tool, forecasting tool, in addition to continually updating our rents based upon comps in the marketplace. So current rents are moving in real time. Projected rents have moved a little bit, as we talked about more recently on the overlay of the moderate recessionary environment. So it's dynamic, right? We're updating rents, we're updating projections in real time. And so what you're seeing on net returns, those largely haven't moved because Michael just mentioned this, costs are not necessarily rising in most of our projects at the pace in which rents are increasing. So I'd say overall, we haven't really moved our net return projections from where we were, say, even 6 months ago.
Yeah. Next question is from Dominic, and I'm going to take one from Darby right after this, so number 2 in a row. Dominic asked, why did you decide to make Sawtell 20% of QOZ 2, $60 million of $300 million fund, which I believe is in excess of your 10% threshold? Great observation, again, by our investors. Dominic, the answer to that is we haven't made that decision, and I'm sorry if that came off. I know that 60 million was there. And we have some discretion around that threshold. Obviously, if we want to over allocate to a deal, put 10 to 15%, but this is actually something that's on the docket for us to speak about in the next week, which is about portfolio allocation. One of the reasons why Edge Hill is being shared between both funds is because the concentration, we don't want too much of that in any one single fund. But you will not see $60 million in this fund in one particular project, and that's the reason for the sidecar. Darby asked, is there a reason you don't expect for cash flow to trend upwards over time? And Darby, I can only tell you that we try to be conservative in these things in the way we model. And I read a great equation that said happiness equals reality minus expectations minus reality. And so it doesn't really do us any good to show this pie in the sky pro forma and market to people, hey, we're going to make 3x and we're going to send you 10%. We're putting into our models and we're putting out in our webinars here what we believe we can send back to investors at a minimum, so you can plan accordingly. Our goal is to outperform considerably, but for us to put on there 8%, 10%, 12% doesn't do anybody any good, especially for planning purposes. So there is a level of conservatism in our model and the way that we market as well, for your own benefit. And just because we don't believe that there's any benefit to us to show you things that are maybe outside of the base case scenario.
I'll jump in on one, Michael. What percentage of the projects would you expect to utilize a GMP? And other than cost, is there a reason to choose a different structure? Great question. And something admittedly we've discussed in this environment. Do we go to, and there's a few different structures that you can evaluate. There's a cost plus, which basically just has us take on all the cost risk, and then you just, whatever the cost ends up being, you would pay the contractor a fee. Usually somewhere it's 10 to 15% above the actual cost to complete the project. We've looked at that, certainly, and because some of our GCs have been willing to still stand by the guarantees, on some of the aspects of the development budget. I will say that, and Michael touched on lumber earlier. Lumber was removed from any sort of guarantee by developers, and that's the loose lumber and the trusses that in each one of these projects, probably about 15 months ago, is really when we started to see GCs say, look, I'm not taking on this volatility in pricing. We're just going to carve this out. This is going to be an allowance to you as the owner. And wherever we buy out the lumber, that's going to be your price. So that hasn't returned back to the market yet, despite the fact that, as Michael noted, lumber is reduced from 1,600 to, depending on the week you're looking at it, 600 to 700, 1,000 board foot. But we're starting to see some of the GCs saying, all right, well, if we're going to settle into this range, we may consider it out in the future of putting that back into our guaranteed maximum price. Short answer to the question, we are trying to get a GMP on every single one of our projects, with the exception of the two AVA build for rent projects, which we could have a whole nother webinar discussion on the nuances of those types of structures. But generally speaking, the market doesn't necessarily provide for a GMP for that type of product. Your horizontal development timeline is usually a little bit longer, and your vertical is a lot shorter. You're only building a single story or two-story townhome, generally speaking. And so oftentimes you do structure a cost plus type arrangement. The other type of contract that we are exploring entering into would be basically a forward price contract with a national home builder, where they would deliver the project in batches at a fixed price, and we would contract out for example, the Ava Madison deal, 200 units, we would buy out 40 to 50 units at a time at a fixed cost, and the national home builder would carry the cost to construct it. We wouldn't need to get a loan for that, and we would just purchase the asset, basically like just-in-time inventory. So those would be the only two deals in the fund that we wouldn't anticipate executing on GMP. Sorry for the long answer, but it's a good question and a complex answer.
Dave, we've got another 5 minutes, so we'll try to be brief on the rest of these answers. I'm going to take one from Scott. Scott, great question. Understood that projects under development must proceed, but how much higher is the bar before signing onto new projects? Is there a thought of limiting? Scott, absolutely. It's math to us, and we're looking for development margin. And one thing, I think there's been a few questions about this, about construction prices, is that costs have been going up for decades. Multifamily real estate, one thing you can be sure of is that in a year, 2 years, 3 years from now, it's going to be more expensive than it is today. It doesn't decline over time. Replacement cost continues to rise. And as long as that math works out and we can develop to a margin of 35%, we're going to do deals. If that stops, we're going to stop as well. And we've shut down funds in the past, and we're not afraid to do it again. So thank you for your question, but I think that's, our goal is to generate returns, not just do deals.
I'll take a live question since I've been doing most of the write-ins, Michael. I can rapid fire a few. John's question was, have you seen any uptick in late payments in your other funds or properties? No, is a short answer. We've seen strong collections trend up from basically towards the end of the COVID era, and we're now returned basically back to call it 98, 99% level of collections. Target IRRs from Anonymous, are they on the individual pages? Are they gross or net of fees? Those are gross to the deal level, is the short answer on that.
I'll take this one. Anonymous, do you anticipate selling assets and recycling the capital? The answer is no. That would create a taxable event. And it is way too challenging to try to 1031 exchange an $80 million property, because you have to be buying a property of equal or greater value. And in ground up development, land is only about 10%. So you're talking about selling an asset for 80 million, buying a piece of land for $20 million, let's say, for example, and then paying taxes on the rest. So that's not part of our strategy.
Estimated timing of edge shell and sidecars, Michael. I mean, I would say that's probably first quarter, second quarter next year.
Mm-hmm.
All right.
If Congress extends the OZ, Thomas is asking this, by 2 years, did you indicate that QOZ Fund II will benefit? The fund doesn't benefit, investors benefit. So, the fund just operates as it does. All the tax benefits happen at the investor level. And yes, anybody in Fund II would benefit from this. And it's really not about the fund, but the year in which the investment is made.
All right, let's see.
Will there be a QOZ fund next year? Dave, I jumped the gun here. Yes, there will be. After QOZ 2, again, Scott asked this question, as long as the math keeps penciling out and we can make money, there will be a QOZ 3 as soon as we hit our cap of $300 million in QOZ 2.
Well done. Elaborate on the project that's split between QOZ Fund 1 and 2. That is the Edge Hill Commons project in Nashville. Designs are underway. We received preliminary construction pricing, which we are working through right now, and we anticipate a ground break somewhere between, again, first and second quarter next year.
Do you see, Alex asked, do you see the war in Europe as one of the major drivers of inflation and supply shortages? Alex, it's to kind of divide this up and figure out where the supply shortages are coming from. Certainly that is contributing to food inflation on that side, and what's happening in Ukraine. It's just awful. But it's really hard to decipher what is causing the inflation, the supply shortages. China shutting down is probably a bigger impact, and what they're with the zero COVID than what's going on in Ukraine. But we're not seeing, like things tied exactly to the war, to what's happening in real estate. There's just not that direct correlation.
The 6 to 7% cash return projections based off of the then NAV or the post 2026 tax payment. Good question. But Michael, I believe the answer to that is that's based on the initial equity investment.
It is. It's based on the invested capital. That's just the easiest way to do it. So, that's our estimate now. So you can look at it. If you put in $1 million, 6 to 7, you'll be getting $60,000 to $70,000 back, during that time period.
Brad asked, our slide deck's available after the call. Yes, please just go ahead and reach out to our IR team. Summary of project costs, equity ask minimum, and maximum investment to hold longer. We can provide specific details. Please just reach out to your client relations representative within Origin.
Okay.
I think there was one other part to that.
Yeah, there was. Brad, I'm going to send you an email. Rob asked, what are the current views on how long the fund will exist beyond the 10-year hold? It's going to exist to the end of the program, Rob, until the last investor wants out. Some people are investing for 10 years, the minimum. Some people are investing till the end of the program, and I think it's 2047. So we have optionality. You can get out any time after year 10 you want, and take your chips off the table.
Question on projected cash flow. If at the year one invested capital is $100, after all return of capital, how much in the distributions, how much invested capital will there be at the end of the year 10? Was Michael indicated previously, if you put $100 in, we're looking at delivering to you, $230 of total cash over the distribution period and ultimately through the liquidation.
Yeah, and I think one thing that's maybe not captured there, that's from Anonymous. I was reading this earlier, and is appreciation. It's not, you're not just getting money back through refinancing, but there's the net asset value of your remaining investment. So your return is a combination of cash flow that comes back and the appreciation and the remaining net asset value. I'll take the last one from John and then sign us off. Do you know if the step up will be retro to closed funds in the new proposed bill? John, I believe so, because by law, if they only extend the program, then they have, sort of, if you're investing 5 years out, you get that 15% step up in basis, and hoping that it's even retroactive to 2021. So instead of getting 10%, we get 15% back there. So we will keep you posted on that. We're obviously watching that really closely. Okay, that is it. I think we went over a little bit. Thank you, everybody, for attending. And if you're a current investor with us, we really appreciate you partnering with us. And if you're a prospective investor, we hope you'll consider partnering with us. And if you want more information If you're a current investor, reach out to your investment contact at Origin. Everybody has a dedicated investor relation contact. And if you're a prospective investor, go to our website. You can connect with us there, origininvestments.com. We make it really easy to download in the investment deck and access any materials and just connect with us directly. So thank you again. Dave, anything on your end to leave with?
No, go USA.
All right. Thank you, everybody.